Good morning, everyone, and welcome to the monthly economic briefing presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Assistant Director Rob Knapp. It's great to be with you this morning. So, if you're with us by video, you may have noticed we've fixed up the place a little. Hope you like it. Joining us this morning will be Professor Greg Brown. He's going to talk to us about this morning's employment numbers. Another topic on the table is policy uncertainty. There's been a lot of news out of Washington the last 2.5, 3 weeks, a lot of things going on. Elon Musk is involved, the courts are involved. So a lot to talk about there, especially as how it might affect the US economy. So Professor Brown's going to talk about that too. That'll start in just a moment. He will give a presentation of about 20 minutes, and then we'll have about 10 minutes for him to answer your questions. You can do that at any point during the briefing by using the Q&A function at the bottom of your screen. Welcome to members of the media. If you send us a question, please include the name of your organization so we can know to prioritize that and make sure that question gets answered for you. If you're joining us by phone today, you can ask a question too. Simply email it to me at rob_knapp@kenan-flagler.unc.edu. I'll keep a lookout for those. We will go till about 9:30, maybe not right on the dot, maybe a minute or two past. We'll see what we've got, but it should be an interesting discussion this morning. So with that said, let me introduce Professor Greg Brown from UNC Kenan-Flagler Business School. In addition to that, he was executive director of the Institute for 8 years. He remains a research fellow, and he does lots of other stuff around here as well. We're always happy to have him back. Good morning, Greg. Hope you're doing well.
Yeah, thanks, Rob. You guys hear me all right?
I can hear you. I can't see it. There, I can see it.
There we go.
All right.
Good. Yeah, okay. So I'm just going to go ahead and share my screen and bring up the slides I'm going to use today. Hopefully y'all can see that now. So yeah, let's just do a quick overview of the employment report. I'll dig into some more details on these in a second. So yeah, the headline number for payrolls disappointed a little bit, but I think that when you figure in the revisions from the last few months is actually a positive relative to expectations, because we had about 100,000 upward revision. Manufacturing slightly better than expected. Average hourly earnings was probably the biggest surprise, up 0.5% versus expectation of 0.3%. And weekly hours was probably the biggest downward surprise. Came in at 34.1 hours versus expected at 34.3 hours. Unemployment rate ticked down, and the labor force participation rate ticked up. So, nothing really dramatic in terms of these numbers. I think this would be viewed, holistically as a solid report. It's numbers like, in the 150,000 range or so are sort of consistent with a stable economy that's kind of continuing to grow at near its trend rate. I think this is consistent with continued growth, and you can sort of see nice good news in it and some things that are worrying. But I think one thing to keep in mind with this is that we do get these annual benchmark revisions in January, and that sort of muddies the near-term comparisons a bit. And so I think we want to take a little bit of grain of salt to reading too precisely into some of these changes, because essentially the base that we're working off of has been adjusted because of better data that the government gets on an annual basis, and goes back and kind of cleans up the preliminary numbers that we see on a month-to-month basis during the year. But yeah, overall, I mean, if you kind of look closely at trends, and this is something we saw before the revisions too. There was a little bit of softening in the middle of the year, and then things have picked up a bit on average. But this most recent number is like just kind of consistent overall with the average that we saw during most of last year. Okay, so let's talk about the surprises then a bit. So again, I said the biggest surprise is probably average hourly earnings. So again, you're sort of splitting hairs here because this is measured in tenths, and the expectation was probably up 3/10, and we're up 5/10. So you might say, oh, that's a big surprise, but it's really just 2/10. And that said, it is at the high end of the range that we've seen for a monthly increase, and certainly at an annual rate, that's quite a large jump in average hourly earnings. And the Fed is keeping an eye on where the economy is, and a very important part of inflation is incomes. People need the money to spend, and that bids up prices. And so, their first order important indicator for the Fed is going to be what's happening to wages, and wages coming in higher than expected, I think almost certainly kind of keeps the Fed on hold. So they're going to view this as probably a slight increase on the inflation risk side. I mean, not a giant red flag, and I think the bond market has sold off a little bit this morning in response to this, but it isn't something catastrophic. But in general, something that would be more inflationary than deflationary, and where the Fed is right now, and with all the things we're going to talk about in a few minutes around uncertainty, I think this kind of seals the deal in terms of them effectively being on hold in the near term. All right, so I think there's some other just little interesting things that we've seen happening recently, and in this most recent report, it does feel like we're seeing more things consistent with normalization of the economy, soft landing, things getting kind of back to an equilibrium that maybe the Fed is happy with if things continue to progress in this way. Temporary help is one of those things that has a very cyclical component to it. And so when the economy is quite tight, you see a big jump in temporary help, and things are booming. And then when things cool off, there's less temporary help. And so we've seen a steady decline in temporary help services, but that's off of a big bump that coming out of the COVID shock was one of the highest rates of temporary help on record. And now we're getting back to a number that I would say is more typical of what we've seen on average over the last 20 years or so. And it does look like it's starting to level off. So like the last 3 or 4 prints that we've seen in the temporary helps suggest that it's kind of landing near this long-term average level, which I think is probably a nice sign, and the Fed probably likes that in terms of soft landing indicators. One other one that is interesting and just came out this week is the JOLTS report, the jobs opening rate. Again, we saw just record numbers of job openings as the economy came out of COVID. That steadily trended down, but again, it looks like it's starting to level off. Some people viewed this as a bit of a soft report on jobs, but I think when you put it in the context of the last 20 years or so, what you're seeing is numbers that are pretty close to what we saw pre-COVID, which was a fairly stable economy. So I think overall, my take on this report is you can find good things, you can find bad things, but for the most part, it's kind of right in line with what would be consistent with an economy that continues to expand at near the trend rate for the U.S. So the topic du jour, I want to move into that a little bit now, is definitely policy uncertainty. So, lots and lots of news out of Washington the last week or two. So I just want to kind of level set and talk a little bit about, what is policy uncertainty, then a bit about, how are the mechanisms by which we might think policy uncertainty is going to affect the economy. And then, I'll try to read the tea leaves and tell you, what I think is in the cards, given the information that we can currently observe. Okay, so what is policy uncertainty? I think in its most general sense, you can think of policy uncertainty as a lack of clarity on what laws, rules, regulations are going to be in the future, and that would include fiscal and monetary policy. So it's potentially a lot. And the concern is that with the new administration, that uncertainty has gone up quite a bit. And we can think very specifically about things like tariffs, immigration policy, which would of course, have a direct effect on labor markets, fiscal policy. So we know that there's likely to be some significant changes in federal taxing and spending policy. And in some sense, these are all things that could affect inflation and economic growth in ways that would then affect monetary policy. So again, all this stuff is potentially connected. What what the Trump administration seeks to do and is able to do on various policies that are priorities for the administration could then flow through to economic activity and monetary policy as well. And economists have sort of thought about policy uncertainty in at least a couple broad buckets. One is you can think about it as the known unknown. So uncertainty about things where there's going to be some decision made, and it's just a question of what that decision is. And so I think a good example of that is the current tax regime being extended. So we know that the previous tax, or I should say probably the current tax regime sort of expires the end of this year, and there'll need to be some act of Congress in order to extend it or amend it in some way. And that's something that we expect. We kind of know that something's going to happen there. We may not know exactly what's going to happen, but there's clearly going to be some policy around tax. Now, compare that to sort of uncertainty about unknown things. And I think there's a fairly long list of unknowns in the sense that we don't really have a good sense of what policy might look like. Tariffs is a great example. So we had our first bout of uncertainty around tariffs just this past weekend, where we had big tariffs and then we didn't have big tariffs, and there's lots of things that could potentially happen, and very little clarity as to what ultimately tariff policy is going to be. Another big one is immigration. So the Trump administration has said it's going to take a very strong position on deportation, but that's actually a very big, hard job. It's going to be very difficult to do what they have said they're going to do, just logistically. It's also going to be costly, and it also is probably not going to be popular. Of course, not popular with the people who are being deported, but also not popular with people whose businesses are affected. And so it'll be interesting to see sort of what the kind of back room political negotiations are there, when deportations could potentially get to the point where they're disruptive to businesses in the broader economy. So I don't pretend to be an expert on either of those things, but I think we can probably agree that there's just a real lack of clarity as to what might happen going forward, and that generates uncertainty. So then what are the mechanisms by which policy uncertainty can affect the economy? Well, in some sense, just decisions become more difficult. We can think about two important sectors for the economy making decisions. The first one being businesses. Businesses obviously make all kinds of decisions about how they operate. A very important one is investment, CapEx spending. And so they may be inclined to be more conservative in their approach to making new investments if they don't know what the economy is going to look like going forward. Or if they don't know what economic policy is going to be going forward. They may take a more conservative stance in terms of risk management and risk mitigation. So if they're concerned about supply chains because of tariffs, labor supply because of immigration policy, then that could cause them to kind of hunker down. And in general, I think this is just going to cause businesses to potentially delay decisions or be more conservative in the decisions that they make, both of which would sort of be a drag on economic activity. Of course, the biggest sector in the economy is households. So households, they might worry about their finances. They might worry about how economic policy might affect their income, but also inflation, right? So we think that sort of both large tariffs and a major deportation would both be inflationary. And that's something that households might respond to. This would tend to make households more likely to save than spend, and that's also going to serve as a drag on current economic activity. So in some sense, economic uncertainty, an increase in economic uncertainty associated with uncertainty about policy is going to result in essentially more risk aversion in the economy. Businesses and households taking a more conservative stance, and that could be a drag on economic activity. So do we see signs of this happening? That's really, I think, the interesting question. And I'm looking at the same data everyone's looking at. It's really hard to tell because there's lots of things that affect data. There's some indicators that might give us a clearer picture than others. So I'll show you some pictures of that. But let me start out by saying, it's hard for me to see it. when we look at what's happening right now with, say, the stock market, with volatility measures in the stock market, what's happening in the bond market, it doesn't seem like people are freaking out. It seems like things are, fairly calm overall in markets. In fact, the stock market has, been hitting record highs. There was, certainly improved sentiment after the election in terms of, what businesses thought was going to happen to the regulatory regime and making things easier to do business, cheaper to do business, and potentially stimulative fiscal policy in terms of even lower tax rates for businesses. So, it seems like the first order effects have been, relatively positive for the economy and for markets, and any sort of depressing effects that have come from an increase in policy uncertainty, are probably second order at this point. Now, that doesn't mean they couldn't, get worse and things couldn't devolve to the point where people are, more freaked out by the uncertainty in policy than, relieved by what they expect the Trump administration to do. But when we start looking at the data, it's hard for me to see. So let me show you some specific pictures here to kind of make that case. There is this economic policy uncertainty index that's sort of widely cited, created by academics, and we did see it jump up. So after the election, it's bumped up to a new level where it's been for a couple months now. But that increase is pretty modest compared to where that index has been over the last 15 years. It's clearly off the lows, but it's way below the highs. I mean, think about how much uncertainty there was around COVID, and even post-COVID, even in the 2023 range, there was higher levels of economic policy uncertainty using this index than there is right now. So yes, an increase, but not an increase to some really unusual level relative to what we've seen over the last 15 years. All right, so let's look at maybe some more consumer types of measures. One way we might think about consumers being worried about uncertainty is the Consumer Confidence Index that the Conference Board does and the Consumer Sentiment Index that the University of Michigan does. And these don't really seem to have budged much. Certainly the Conference Board one is sort of leveled off, and it's kind of slightly above average range. The University of Michigan one is also sort of leveled off and a little bit below average range. These sort of measure different aspects of consumer feelings. And so, we've talked in previous briefings about what drives these, but it's really the questions they ask. And in particular, the University of Michigan one has essentially a higher weighting on inflation, and that's why it's negative, and the Conference Board one is positive. But when we look at these in terms of recent trends, there just doesn't seem to be anything that's like dramatic that's happened from a consumer standpoint. And maybe we want to look at things that are instead of opinion based or sort of soft type things, harder types of measures. So we could look, for example, at employment in the construction industry. So, we know housing is important for the economy. It's a big decision that households make. If people are feeling uncertain about their economic prospects, they're probably less likely to take on, something a major new financial obligation like a new house. And we know the housing market's been challenged recently, but it doesn't seem like it's changed much in the last few months, right? The challenges, have been more to do with sort of high interest rates and people locked into existing mortgages, but we haven't seen anything that sort of looks like a sudden, dip in employment in the construction industry that I would want to associate with potentially people rapidly pulling back from the housing market. So those are just a few indicators. There's dozens of different things that folks could look at. There's the kind of CFO surveys, CEO surveys. These give sort of the opposite indicator. Like, people in the business world seem to be pretty happy with the prospect of what the Trump administration is going to bring, even given the uncertainty about what policies might be. I think I would read this as they're maybe uncertain about policies, but they're pretty confident that they're going to be good policies for business. And so, there's been a jump, especially in the independent business, small business community, in terms of what the Trump administration is going to do on a regulatory front. So it's hard for me, I guess, to kind of read the tea leaves around things that are indicators, various statistics that we might cite related to economic uncertainty, and see that there's been a dramatic increase that would directly affect the economy. But it's early days too. So if things got really testy, spiraled out of control, and there were sort of unanticipated roadblocks in Congress to doing things, certainly the situation could deteriorate so that people became increasingly uncertain and less optimistic about what the economy was going to do. But it just doesn't feel like we've seen that yet, based on both what we see with the kind of economic data, survey data, as well as what's happening in financial markets. So I'll stop there, Rob, and if people have questions, I'm happy to take a shot at them.
Great, thanks very much. And people do have questions. I will remind folks who are with us on the phone today, you can send questions into me by emailing them, rob_knapp@kenan-flagler.unc.edu. Got a few to start with here. Here's one from Lauren Osorge at Triangle Business Journal. Interested to know how the uncertainty angle may play out in the triangle, where obviously the EPA has a massive campus in Research Triangle Park. There's the presence of RTI, FH 360, which already announced furloughs, so much federally funded research powering the region. What do you think this all translates to in the triangle specifically?
Yeah. I mean, I think we probably are more exposed in the triangle than many other metropolitan areas because of the mix of industries that we have here. Certainly, the healthcare industry is at risk. Anything that's federally funded is at risk. I would say potentially even university funding is at risk. There's been a shockwave going through the academic community that we've been witnessing here at UNC about exactly what some of the executive orders mean for federal funding of university research. So if the worst case scenario is realized there, and there's substantial cuts in federal funding or federal employment at agencies, that is something that could disproportionately affect the triangle economy.
Okay, thanks. This one's from Dennis Holland, and this is just sort of a broader look at what we were just talking about. Perceived impact of DOGE, and that's the group and not the.
Yeah. No, I mean, I think we're all watching this unfold and sort of just wondering what's going on. There was a mandate for Trump to come in and do something with the federal government, in terms of depending on your political views, drain the swamp or increase efficiency, or however you want to do it. I think probably most reasonable people would say there are potentially places where you could increase efficiency of government operations, at any level, right? At the federal level or the state level or local level. It's not clear that what Musk and DOGE are doing is sort of a reasonable, rational approach to that. It doesn't feel like they're going into agencies and saying, okay, these agencies have 13 divisions, and it would be much more efficient to combine these two divisions and reduce staffing on this one because that's legacy programs that aren't that important, and kind of going with a scalpel and make very intelligent decisions about how to increase efficiency. It feels like sort of a meat cleaver approach, where you go in and be like, hey, anybody who wants to quit, we're going to buy you out, and not very thoughtful as to who those people are, whether it's the right people, the right divisions, those sorts of things. So, and then whether this is really going to work or not, I think is and work is maybe the wrong word. Whether this is even going to happen or not, I think is uncertain, because now with legal challenges, and the question as to whether there's the authority to do this without Congress acting. So courts move slowly. DOGE seems to be moving quickly. It also seems that there's not a huge concern about the legality of some of these things before taking actions. So I think it's very uncertain as to what's actually going to be the effect on the economy. And I will doubt that there's massive gains in efficiency from the approach that's being taken right now. There might be a decline in federal spending if lots of people do end up losing their jobs, and that would be at least a short run negative for the economy. As in the same way we just talked about for the triangle. Yeah, that's a highly uncertain one, for sure. And where it lands, nobody knows. I'm not sure it's a first order important for the broader economy. I don't think Doge sends the economy into a recession or causes it to have amazing productivity that is a first order effect in either direction.
I was going to update a question that we get from time to time that you may have just led into. Sometimes when it seems like the economy is adding a lot of jobs in the government super sector as opposed to some of the other ones, people will ask, well, do government jobs count as much really as other sectors do? So I guess the question here would be, if government jobs are lost, at least for the case of the broader economy, does that affect the economy less than we were talking about construction jobs and things like that?
Yeah, I mean, it sort of depends on how you look at it. So, the government struggled to hire people coming out of COVID, right? So it had been playing catch up for quite a while. Now, any employment is going to have a positive effect on the economy because you have more wages out there, and that's more income. It's more income that's going to get spent. So in that sense, it's a doesn't matter whether it's a government job or a private sector job. If somebody's making $50,000 a year, they're gonna spend that money probably the same way if it's a government job or a private sector job. So in that sense, it doesn't matter too much. I think where it does matter is sort of trying to understand what that means for the ongoing health of the economy. So if it's the government just playing catch up and filling empty positions, that's not a super bullish outlook for the economy. If it's a private sector adding a lot of jobs in high growth or cyclical sectors like construction or manufacturing, then that's a very bullish indicator because it sort of it exhibits it shows that the businesses have confidence in their ability to hire and continue to grow, and we know that those things are persistent over time. So it's sort of a bullish indicator for what will happen in the future.
Okay, thanks. Let's jump back to tariffs, which is one of the first things you started talking about. Barbara Senich asks, I saw some of the announcements of tariffs. Is the administration creating bargaining chips for other purposes, at least with respect to Canada and Mexico, getting our neighbors to take a harder stance on illegal drugs and the like? Could this explain the relative market calmness in the market?
Yeah. I mean, I wish I knew, right? I mean, it's just fascinating to watch. I think it's hard to disentangle policy objectives from personal objectives in some sense. I think Trump is obviously a person with a big ego. He wants to assert himself as powerful, as kind of returning to the throne and rattle some cages. And to me, that's what the Mexico and Canada tariffs were about. Some of it could certainly be about interdiction of drugs or immigration policy, things like that. But it didn't feel, I mean, again, doesn't feel like it was sort of targeted in a very specific way. Like it doesn't feel like the drug interdiction issue with Canada is a real issue. It's apparently almost a non-existent problem with drugs coming across the Canadian border, but they got slapped with the same tariffs that or at least proposed tariffs that Mexico did, where it's a major problem. So I guess my take on it was, yeah, bargaining chip, or maybe just a signal that he's back and serious and it's time to pay attention. And but in terms of something that's seems like a very coherent economic policy, it didn't come across to me as that.
Okay. Here's something else that's been in the news lately. What about uncertainty over avian flu's impact on the economy, supply chains, local producers in North Carolina?
Yeah, I mean, everybody's heard about egg prices. It's a real concern for the ag sector, and I think in North Carolina, but at other parts of the country as well. I think it probably isn't something that will result in a kind of a major macroeconomic situation unless we see something that starts affecting human health in a serious way. So if it turns into something like a pandemic type risk, and there's the types of effects wouldn't have to be anywhere near as bad as COVID, but things where you had restrictions on people's movement or ability to work in certain areas. Those are the kinds of things that would affect the broader economy. So yeah, terrible for the people that are affected in the ag sector directly. A mild negative for households that like to eat eggs. But in terms of the as long as it stays contained in the bird population, not something that should have a major effect on the broader economy.
Okay. One more, and to be honest, I'm not sure if this one's in your strike zone or not. So if you want to say no thanks, that's fine, that's legal. Will you please speak about how you're measuring impact of AI on the workforce in terms of productivity and employment levels?
Yeah, I mean, that's a great question. I don't think it's a question that is going to have like a short-term impact on the numbers that we're looking at. I think this is something that is going to have a major long-run effect on the economy and the types of jobs that people have and mix of employment and all that sort of stuff. There's lots of different opinions out there. You're right. I'm definitely not an expert on that. I think the early research suggests that there will be significant productivity improvements in many sectors of the economy, but we expect those to play out over years and decades, the same way that other technology shocks have happened. Not something that's going to like hit first quarter GDP.
Okay, all right. Greg Brown said he was ready for questions, and he was ready for questions. We knocked them all out of the park. So thank you, as always, to Greg for his insights and his time. We appreciate it very much. Thanks very much to everybody who was here today and those of you who submitted questions. That helped keep the briefing going, and we appreciate it very much. I would remind the folks in the media that if you would like to talk to Greg or any of our experts or are interested in anything we're doing, you can let me know. I'm at Rob_Knapp at Kenan-Flagler.unc.edu. For everybody out there, please take a look at our website. It was a very busy January. So you're going to find some new things there. Kenaninstitute.unc.edu. One of the things you're going to be looking for is our grand challenge for 2025. We're going to be talking about the skills gap. We're going to be talking about it a lot, so you'll probably hear it come up on the briefing and elsewhere. But take a look. You'll see what we plan to look at and how we plan to do it in the story on the website. Also, some new things up at empoweringamericancities.com, which is part of our collaboration with Fifth Third Bank, where we're taking insights and data to communities around the country to help them grow. We have some new regional economic snapshots up. We also have a 2025 outlook up. Think you'll find those interesting as well. So appreciate you being here. We hope to see you again on Friday, March 7th, when we'll do this again. But until then, thanks again and enjoy your Friday.